The IPO window is open as recent AI and fintech IPOs thrive, but the window won't stay open forever. It's time to file those S1s. In IPO Radar news, Circle and StubHub IPO updates, and OnlyFans' only owner has too much skin exposed and is ready to pull out. Welcome to the Access IPOs podcast, where we explore opportunities to invest in the world's most innovative and disruptive pre-IPO companies. I'm Craig Stevens, founder of AccessIPOs.com, and we need to open our eyes. The IPO window is open, and I think it's actually been open for quite some time, dating back maybe even to mid-2023, when the Kava IPO opened up more than 100% on its debut. I think that marked really a new window opening. Remember, there was that euphoria of 2021, and a lot of companies took advantage of that period. Certainly some SPACs also took advantage of the opportunity to go public, but they took advantage of retail investors. A lot of the SPACs failed. A lot of the IPOs didn't do well, including some of the highest profile ones like Rivian, and Lucid Motors was probably the highest profile SPAC that also didn't do very well. 2022 was a bit of a recovery year. In 2023 with that Kava IPO, and then I think some of those companies that went public in 2024, like Reddit, Rubrik, Viking Cruises, and we saw great performance from those 2024 IPOs. And then headed into 2025, several companies were moving forward. And then, of course, we had the tariff announcement on April 2nd, which put a short-term freeze on IPOs, but we're back. I mean, we've seen some fintech IPOs come out strong. We've seen the CoreWeave IPO. It's very strong performance out of the gate. If you're a CEO or a startup founder who's thinking about a public offering and going public, now's the time to move forward. You want to do it before things get out of hand. And remember, the IPO window is always open for great companies with great management and great businesses. So even in 2022, some great companies could have gone public. It's just that the underwriters don't want you to IPO into a volatile market because that can hurt their business, and the issuers may not raise as much money. And so you do want to IPO into a bull market generally, but it really shouldn't matter for great companies. Let's take a look at some of the data. All right, I'm looking at stockanalysis.com. They've got a really good IPO center. And the chart we're looking at now is IPOs from 2000 to 2025. Going back to 2000, you can see that .com bubble, 397 IPOs. But really, we're looking at the last 5 years or so. And in 2020 and 2021, you can see that surge that went from a small number of IPOs, especially in that 2015, 2016 timeframe. And then we got this euphoria in 2021. Now, the last IPO window, in my view, it opened somewhere around that 2018, 2019 timeframe. Uber was the big IPO that everyone was waiting for, even back in 2015, 2016. But it took them several years to move forward with their public offering. And Uber was also one of these first companies to really wait a long time to IPO, to stay private longer. And by the time it IPO'd, it was worth too much in the private markets. They overpriced the IPO and it fell flat. And it hasn't really been a great performer since. All the growth happened as a private company. But that 2019 Uber IPO did sort of kick off this euphoria that happened between 2019 and 2021. Airbnb went public in there. And then you had several of these companies that were just going all in because the market was receptive to the IPOs and overpaying, and that's what happened in 2021. We had Robinhood and Coinbase and several other IPOs, but it really all peaked with the Rivian IPO at the end of 2021, and that marked the end of the euphoria. But also during that time frame, there were a lot of SPACs. And everyone knows that SPACs, or special purpose acquisition corporations, haven't performed well, and a lot of wealthy people got wealthier from SPACs, and when retail investors invested in these companies, a lot of the prices fell. You would think that investors are skeptical of SPACs, but it looks like there is this resurgence of SPACs happening in 2025. And looking at the numbers now on this chart, I'm sharing my screen if you're following along at home. In 2025, we're already at 140 IPOs. Last year, 2024, there were 225, but this 140 this year looks like we're ahead of pace for the year compared to last year. But what I found is that a lot of these IPOs that are happening this year, they're just these acquisition corporations. And so the surge of IPO filings hasn't really happened, even though the data makes it look like it is. If you go to this recent tab here in 2025, Just scrolling through the names here, a lot of these have this acquisition corporations. We have Jenna Acquisition Corporation 2 and Wintergreen Acquisition Corporation and Champions Gate Acquisition Corporation. And they're all priced at $10 a share. And when they IPO, the price doesn't go anywhere. And that's because these companies are trying to do a SPAC merger. And we found that these just don't work well for retail investors. So it's a cheap and easy way for a mediocre company to go public without doing an IPO and all the work that's involved with the IPO. They can avoid all of the S1 filings and all the scrutiny that needs to happen initially, and just the headaches and the costs of going public through an IPO, which there are several. But for smaller companies, it can make sense to do this through a SPAC. I generally consider a company that SPACs to be lower quality and maybe doing it sooner than they should, and the data supports a lot of that. So looking at these 2025 IPOs, there's just not a lot of volume. And you can sort by market cap, and when we do that, you can see what comes to the top, and that's CoreWeave, Venture Global, which didn't have a great IPO, but is still worth $28 billion. In fact, Venture Global, they were talking about that being a $110 billion IPO. Turns out it's only worth about $28 billion right now. SailPoint, Smithfield Foods. And then down below, you see some of the more recent ones. You got eToro and Hinge Health. Those are the ones that we followed, and they're performing well. eToro is up 20% from its IPO price. Hinge is up 22%. You got Newsmax, which was a conservative radio TV media company. It's up 100%. You got Mountain. That was the Ryan Reynolds company we covered a few weeks ago, up 62%. So these recent IPOs that we've been following, these high-profile IPOs, are doing very well. They're positive reception from the market. CoreWeave being an AI pure play, up 163%. You got to think that other AI companies are thinking about moving forward and seeing that. It's now a $52 billion company. You can also sort by return, and there are some of these smaller cap companies that have had some pretty crazy returns, and most of these companies we don't follow because there just isn't a lot of interest. But there's also some real duds that have come out this year. And this is why I don't follow just all IPOs. There's other websites out there and maybe other podcasts that talk about just all IPOs. And I don't care about most IPOs. I care about the top 10 of the year, or the top 50 of the year that are going to be exciting for retail investors. Known names, brands that are recognizable, and technologies that people know and understand. And of course, a lot of the highest profile companies are going to be the highest market cap companies and the most splash when they enter the market, like an Uber or an Airbnb. I'll go back to 2024 and talking about this IPO window being open back in 2024, sort by return. And there we have Reddit. Reddit was a March 21st, 2024 IPO. It's up 220%. Rubrik is up almost 200% from last year. Amer Sports up 183%. Astera Labs 168%. So looking back at 2024, the IPO window was clearly open. I tweeted about this back in February. Hey, open your eyes. The IPO market is open. It's time to move forward. I think companies are lagging for whatever reason. They're not moving forward. We have a few signs of companies moving forward in 2025 and might finish their IPO in 2025. But the window was open last year. We go back to 2023, and we have Kava up 272%. ARM Holdings was another big one that we covered. That's up 151%. There weren't as many big name IPOs in 2023. Maple Bear or Instacart was another one. But these are all up pretty solidly from their IPO prices. Of course, you've got your duds too. I'm sorting here by return. You've got companies that are down 90+%, 99%, some of these. So a lot of low quality IPOs come out, and we're just not interested in these holding companies, or you get a lot of biotechs. And so biotechs, their business model is to go out there and be public and go through trials, and it's a way for them to raise money. So there is a reason to do this, but as a retail investor, unless there's a really compelling argument, or if you're a penny stock trader, there's really not a reason to follow these companies. You can see a lot of companies down very much from their IPO price, but it's these high profile, the Kavas, the ARMs, the CART companies that are the ones that we're watching in the next IPOs that are happening. And typically they're 5 to 10 billion or more. So if it's really below 5 billion, or if it's below, I'd say even 3 billion, we're not all that interested in it. Occasionally we pay attention for smaller deals, but when you get into that 5 and above range, that's when retail access becomes more accessible to more people. And we're seeing that with Circle right now. There's multiple brokers where you can indicate interest, and we'll talk about Circle in a little bit. So looking at this chart again, the statistics, 2025, 140 IPOs so far. Those aren't all IPOs that we pay attention to. A lot of them are the SPACs and holding companies and Chinese companies that are just filing here. But the companies that we've followed are all doing well, or almost all doing well, except for Venture Global, and incredibly so with CoreWeave and AI. And so what's that tell you? It tells you that if you're an AI company and you're thinking about going public in the future, now is the time to really start thinking about it. Anthropic, for example, $60 billion company. Do they want to wait to go public or get it out now while things are going well for the company? OpenAI, we know, is trying to restructure their business so they can take that company public, and that'll be a blockbuster. And then fintech, we're getting examples. eToro has done well. Circle is coming up next week, and we know that Gemini's in the pipeline, and Kraken and Chime. Right, so we've got a lot of fintechs. Now, fintechs led a lot of that surge in 2021, so maybe investors still have a bad taste in their mouth. We are seeing companies like Robinhood and Coinbase recover from where they were in 2022 after their euphoric IPOs. And so now that those companies are recovering, a couple fintechs are coming out strong. We've got Klarna in the pipeline as well. And we have a environment that is friendly toward crypto and fintech. Then we could see another surge now of IPOs coming. And like I said, the time is now to file these IPOs so that you can beat the euphoria. Now, I see similarities to 2018, 2019, whereas if I'm a startup founder and I want to IPO, that I'm thinking about getting it out in a year, and you want to IPO as the IPO window is ramping up and before it gets to that euphoric area where prices are out of control. You want to have an IPO with a fair price where anybody who participates in the IPO makes money, but you also give investors, retail investors, a chance to own your company at an early stage so they can participate in the growth. Uber waited too long, Airbnb waited too long, and I'm afraid the companies like OpenAI, Anthropic, Databricks, probably a very good example of Databricks, have all waited too long, and that their growth is behind them. And if they IPO now, maybe they'll get a spike, but the really long-term gains that retail investors want to buy and hold for a decade or more, they may not be available if they keep waiting and doing the tender offers and not IPOing. Retail investors just aren't going to have that opportunity to participate in extraordinary growth that we'd like to see. So all of you founders out there watching the show or listening to the podcast, I'm sure there's hundreds of you. The time is now to move forward. The IPO window has been open. It remains open, and I think it will remain open for as long as the market is stable. Could be running into some headwinds with tariff changes, with a potential recession, which we may already be in a recession. So there could be some headwinds, but mediocre companies, yeah, you should worry. But companies that are strong fundamentals and strong revenue growth, the IPO window is always open. We want to see more of these companies come out at an earlier stage of their growth so that retail investors can both participate and we can get these into our index funds and participate in the long-term growth of great companies, of the next innovative and disruptive companies coming through the public markets. Because as these big companies get older and fatter, they're going to slow down their growth. And we need the next generation of growth companies to get out there into the public so they can fuel our retirement accounts. And if you're investing in individual stocks for the long term, it's an opportunity to participate in that growth. Let's move on to IPO Radar news. I loosely define an IPO Radar company as one that I've written about on my website. It's somewhere around 150 or so companies, and some of them fall off when they IPO or they get acquired, or some companies just sort of don't grow and become obsolete. But for the most part, we're trying to identify the IPOs that are going to be happening in the next year to 5 years. And these are companies that have public interest that investors want to own and want to have as part of their portfolios. People ask me how I come up with the IPO Radar companies. I have various data sources, but a lot of it is just gut feeling. Like when there's a company that raises a substantial amount of money and the business sounds interesting and it's growing fast, the financial media perks up and investors perk up and want to learn more. And that's when they start coming to my website, when I try to identify these companies before they get interesting to retail investors. And it's really a data-driven decision with a little bit of gut on the side and how I come up with these radar companies. Once they're under my radar, then I monitor the news and update the web pages whenever something significant happens. And members of our Access Club community get those weekly updates. Everything that gets updated on the website goes out to our Patreon members on a weekly basis, so you know what's happening in the entire universe of really the startup world, but more so within the IPO Radar companies that we follow. First up, let's talk about Circle. So last week, if you remember, the episode was all about Circle and how there was a potential acquisition going to happen between either Coinbase or Ripple buying out Circle. And we learned a couple days later on Tuesday of this week, the day after Memorial Day, that Circle, I guess, gave them the hand and said, no, we're going to move forward with our IPO. And that's understandable. I mean, they put a lot of money and a lot of effort into building out the S1 filing just alone, getting that SEC work done. When you watch the IPO Roadshow, you can see that they put a lot of effort into producing videos, and these people have been moving forward with this IPO for a long time. While it's still possible that Coinbase could swoop in and take out Circle before it IPOs, I think it's very unlikely at this point, although I have seen that in the past. I can't remember which companies that's happened to, but I think at this point we can pretty much bet on Circle IPOing. Next week, the IPO date is set for June 5th. That's a Thursday, so the deal will price Wednesday night. On Tuesday of this week, the S1 filing was amended. We got the terms of the deal. The offering is 24 million shares. And one of the interesting pieces of this IPO is that they're offering 9.6 million shares of Class A common stock. They're issuing that much new stock at $24 to $26 is the price range, the initial price range. But they're also selling 14 million shares or 14.4 million shares of Class A stock from existing shareholders. In other words, venture capital investors who have invested in this company a long time ago are looking to liquidate some of their holdings going into this IPO. So I saw this in the filing the morning it came out, and I looked at it first, okay, 24 million shares, let's multiply that by 26 to see what the raise is, but that's not how it works. The raise is actually this 9.6 million shares multiplied by the IPO price, and that's around $250 million is the raise here. That's not a big raise for a $6 to $7 billion company, but they are selling shares from these existing shareholders, and there was a CNBC article that really highlighted this, and they're basically saying that venture capital firms need liquidity. They need some liquidity so they can go off and invest into the next generation of startups so that they can pay back some of their investors, some of their limited partners. And they compared this deal to Facebook 10 years ago, 15 years ago. I don't know when it was, but Facebook had something like 57% of shares from existing shareholders who sold. And this deal has something like 60% of shares are existing shareholders are selling shares into this IPO. And there could be a lot of other reasons why. When there's a lockup period of 180 days, that would mean that if the existing shareholders held through the IPO, they'd have to wait 180 days before they could liquidate shares. And that's just too long to have their money tied up. They'd rather get some of the money out now at a known price than wait 6 months and wonder what the price is going to be. So you've got the founders selling some shares. Now, this is a $6 to $7 billion market cap company as it stands with this $24 to $26 price range, this initial price range. And I'm seeing shares available for retail investors on Fidelity, on Webull, and on Robinhood. And so this is a great deal for retail investors that are getting shares out there, but it's still a small deal. So it's $6 billion. It's maybe not likely that we're going to get access to this. Usually at Robinhood, you can get an allocation, but it might be just 1 or 2 shares. Webull, I'm not sure how that's going to work. I put in requests at all 3, so I'll let you know how my request at Webull goes. One of the issues with Webull, though, is you have to have money cleared in that account to be able to participate in these IPOs. With Robinhood, you can just deposit money right there and then put in your request. But Webull, you have to have cleared funds. That takes about a week. So I didn't have a lot of money there. So I put in a request for as much money as I had, and we'll see what develops. Fidelity, I put in a substantial request, and I usually don't get shares from Fidelity. When I do, it's a sign that there's not a lot of demand. So I'm not expecting much out of Fidelity, but I do expect maybe 1 or 2 shares from Robinhood or Webull, but we got to take what we can get. If you can make bigger requests, you might get more shares. This is the first JP Morgan deal we've seen in a while, and I got to think that JP Morgan wants to price this below the market value so they can get a pop for some of their investors and also drum up some more business for just the future IPOs. The last high-profile IPOs we've seen go out have mostly been Morgan Stanley and Goldman Sachs, and JP Morgan has been part of that, but this is the first we've seen that's like really a JP Morgan-led deal. And so I think they want to price this thing low and get a pop to generate a lot of excitement around this deal. But you also don't want to underprice it too much because then you're not raising as much money. Interesting, though, with this deal is that Circle's not trying to raise a lot of money. They're only trying to raise $250. So I'm guessing that we might see the range increase next week before this deal goes out. They might increase the range if they're gauging demand. And we also could see an increase in the number of shares being issued to raise more money. Because if there's demand for this deal, they'd be leaving a lot of money on the table if they're not issuing more shares. But at the same time, this company is profitable. And so they may not need money to grow. Doesn't seem like Circle is doing this to raise money. They're doing it to raise their prestige as a cryptocurrency company, as the USDC being the stablecoin of choice. And so that would potentially give them an advantage over a competitor like Ripple. It's going to raise their profile just in the broader financial world. I think they're showing some leadership here as well, that they are a cryptocurrency pure play company and they are going public and they don't care what's going on with the market. So a big change since last week. It looks like that acquisition stuff is gone. It's in the rear view mirror. Circle's going to move forward on Thursday. We'll be watching that one closely. Follow me on X, Twitter. I'm always tweeting about this stuff, especially the night before and the day of the IPO. You can search the $CRCL, and a lot of times I come up there, or just go to my profile at Access IPOs. You get me for live updates that morning of the IPO. Assuming I'm working that day and at my desk, I'm usually pretty good at following along and updating the page as this news happens. So fingers crossed we have a good IPO next week for Circle, and that continues the momentum of these fintech IPOs that are being well received in the public markets. So speaking of upcoming IPOs, there's another IPO that we talked about a few weeks ago, maybe even a few months ago now, that we haven't heard much from them since, and that's StubHub. So StubHub is e-commerce, ticketing. Obviously, we know what StubHub does, but it's hard to really qualify it as part of an industry. We know that it's ticketing. We know that it's e-commerce, I suppose. It's sort of a SaaS. So it doesn't really fit into a mold like a fintech mold or an AI mold. Nonetheless, it's ready to go public, but StubHub was one of the main companies that was hit by that IPO freeze that happened April 2nd. So we hadn't really heard anything other than that Wall Street Journal article that came out, I think, April 4th. That said StubHub's pausing. And who could blame them? The market went down. It was a scary time. The market's back. And so we got an article out of the Wall Street Journal, which certainly seems to have the inside scoop on all things StubHub. And the article is called StubHub CEO Isn't Delusional. That's why he hasn't IPO'd yet. Now, I would argue that maybe last year he was a little delusional to say, or whoever said, maybe it was the underwriters, that the market was too choppy to IPO in 2024 when the market was going straight up. But they changed their tune. They were brave enough to go forward in 2025. Kind of chickened out a little bit on that April 2nd news. But now we got this article from Wall Street Journal, kind of explains the thought process behind the decision not to go public during the turmoil and the fact that they want to go public. So I thought this was a pretty eye-opening article just to get a little bit of the inside scoop. And it's almost like the CEO is trying to justify, like, hey, man, I wanted to go public, but talking to the bankers, we decided it wasn't the right move. And it would even be a move of desperation if we had IPO'd into that tariff volatility. So it says here, StubHub Chief Executive Officer Eric Baker met with his bankers to discuss the precarious state of the company's planned initial public offering on April 3rd. Remember, April 2nd was the tariff announcement when Trump came out and said, we're going to tariff the hell out of everybody. Stocks had just shed $3 trillion in value because of Liberation Day. And on the call with bankers, Baker likened launching the IPO to going out the week after Lehman Brothers' 2008 collapse in the depths of the financial crisis. Quote, if we went out now, people would either think we're delusional or desperate, and we are neither. Baker said his bankers at Goldman Sachs and JP Morgan decided to push off StubHub's long-planned IPO again. The article goes on to talk about the background of the company, and you can read that on my webpage for StubHub. You just go to the accessipos.com. There's a search button in the top right corner. Type in StubHub, you come to the article. Or you can go back to the early episode. I dig a little deeper into the company and the history of StubHub. But the key sentence here, the key part of this article, it says Baker has been talking to his bankers several times a week about updates, and StubHub's listing is now looking more likely to be in late June or early July, according to people close to the offering. So there you have it. There's an update from StubHub pretty much saying, hey, we're going to do this next month. I'm recording this today. It's May 30th. June is around the corner. If they're talking about an IPO at the end of June or early July, we would expect to see an amended filing sometime in mid-June. maybe the second or third week of June, or if it's at the end of June, then we'd see it going into July. July 4th is a Friday this year, so possibly we could see the IPO that following week or sometime in June. But interpret it the way you will. StubHub wants to go public, and as long as the markets stay somewhat stable, I think his bankers are going to move forward. He obviously wants to take this company public. We were looking at, I think, a $16 billion valuation, and I think in this market environment right now, that holds up, and they're able to raise some money and launch this thing. And there isn't going to be a lot of tariff impact to this company. These are tickets to sporting events in the U.S. These are tickets to concert events in the U.S. And as far as we can tell, none of that's really slowing down right now. Certainly not like it did during the COVID times. StubHub took a real beating. This guy bought this company somewhere around a $4 billion valuation, and it's now looking at a $16 billion valuation. So buying this into COVID and then exiting a few years later, I think is really a testament to this guy. This guy's going to maintain ownership of this company, a big piece of the voting share. So if you're investing in StubHub, you're investing in Chief Executive Officer Eric Baker. Watch for that one next month. One last story for you, and this is a company I think a lot of you guys out there know about. You don't have to admit it, but it's a company with a lot of public interest, meaning people are asking the internet about it, and it has a lot of real estate on the internet. And that company is OnlyFans. OnlyFans, if you're not familiar, it's okay to pretend you're not familiar, but OnlyFans is a paid membership site mostly for adult creators. Now, I'm a creator, right? I create my podcast, I write on my blog. I'm a creator or an influencer. But there are several creator/influencers who post adult content on the internet, and OnlyFans allows that to happen in a way that's user-friendly both for the creator and for the consumer or the paid members of this website. As a company that operates in the adult world, the number of investors is going to be limited. Now, I've written about this company in the context of a potential IPO, and that really doesn't seem likely at this stage, and maybe it's never seemed likely because a lot of investment firms, which could include institutional investment firms or pension funds or college endowments, have rules within their founding documentation that says they can't invest in certain vice companies like pornography. And so if OnlyFans were to IPO, it may not have the institutional investment interest, even if there's lots of individual investors that would want to invest in this company. The news this week came out of the New York Post, and the article is called OnlyFans Billionaire Owner Quietly Looking to Cash Out, but Booming Smut Site is Struggling to Find a Buyer, according to sources. Now, this came out on May 21st. It was actually last week. So this guy, his name is Leo Radvinsky. He owned an adult webcam service before purchasing a majority stake of 75% of the holding company of OnlyFans, which is called Phoenix International Limited. A guy named Tim Stockley founded this company back in 2016, and he ran it till about 2022. And as far as I can tell, Leo Radvinsky bought the remaining share of this company from Stockley in about 2022. There's filings to indicate that he owns 100% now of this Phoenix International. So Leo Radvinsky owns what's arguably one of the best companies out there, one of the best SaaS companies to ever exist. I had read about this and I knew this was a fact, but I also found this tweet recently. Somebody shared this image. It says, OnlyFans is possibly the most revenue efficient company in the world, and no one even comes close. And I'm showing on my screen this chart that shows revenue of OnlyFans. Revenue per employee is $37.6 million revenue per employee. And second, the most revenue efficient company in the world is NVIDIA at $3.6 million in revenue per employee. Cursor, which wrote about recently, Cursor is owned by Anyscale. It's on this list. Apple is on the list at 2.4. Check out this graphic on the video if you can, but it's got this list of really the most efficient companies out there: Amazon, Tesla, Microsoft, OpenAI, Alphabet, Meta, the best companies of our time. And OnlyFans is at the top of the list, 10xing number 2, which is NVIDIA. So this is a great business. It's a cash flow business, a cash cow. Essentially, the platform allows creators to create this content behind a paywall. And so they can put nude pictures of themselves or nude videos or whatever on that website, and nobody can see it unless you're logged in and a paying member. This throws off a ton of cash for this guy, Leo Radvinsky, and he's pulling out $500 million to $1 billion a year in dividends from this company. It's really just an extraordinary business story, but he doesn't really want to own this company anymore. He's looking to pull out. Then a few days later, Reuters came out with a pretty good story on May 23rd. It gave us a little more insight into what's actually happening with this OnlyFans situation. And the Reuters article is called "OnlyFans Owner is in Talks to Sell to an Investor Group at about an $8 billion valuation." Now, if this were any kind of non-adult website that was this revenue efficient and throwing off this much cash, it'd be selling for a lot more than $8 billion, it'd be worth a lot more than $8 billion, but there aren't a lot of buyers or potential buyers out there. So the article says here, OnlyFans exploded during the COVID-19 pandemic, best known for an online platform that enables porn creators to charge subscribers for content. OnlyFans takes 20%, which is very high in the space of this kind of online content community. I have one of my own, and I'll tell you about that more in a second. The company generated $6.6 billion in revenue at the end of 2023. So extraordinary business here. And there's a company called Forest Road that apparently is looking to buy this thing out. It says in the article, some executives at Forest Road, which is an investment firm based in LA, which doesn't surprise me that it's in LA, were part of a special purpose acquisition company, SPAC, that was in talks to take OnlyFans public in 2022. So OnlyFans was looking to SPAC in 2022. Imagine that. We could have invested in the stock market. But some of these people that were involved in these talks are now with this Forest Road company. The company's sole shareholder is Leonid Radvinsky, a Ukrainian-American whose location could not be confirmed. It's actually a London-based company. So it's one to watch. People are still interested in the ownership of this business. So even if this deal happens, it's probably going to be a private equity deal. It's not going to go public, although the article does say that they are still considering, says the company also considers an IPO while fielding interest from other suitors. So perhaps he's out there fishing this thing around and see if he can get top dollar, or possibly he's talking to bankers about an IPO or a SPAC. And there's a lot of acquisition companies out there who I'm sure would be willing to SPAC, but how a porn company would behave in the public markets or how it would, be received in the public markets is a bit unknown. Now, OnlyFans has made some efforts to attract other creators who are not porn creators. In fact, there are a lot of creators on there in fitness, in sports. So you might have a sports athlete who has an OnlyFans page. And when I was looking to create an online community, I was looking at the various platforms, and I ended up going with Patreon, which is a little more suited for my audience, but there's a bunch of these. One's called Buy Me Coffee. Another one, Substack is a really big one for bloggers. Beehive, I think, has some features that can be put behind a paywall. And some of these other platforms may not allow adult content. I'm not sure if Patreon allows it or not. Probably not. But I was at a conference and I met a marketer from Substack. And Substack's more of a blogging platform, but I think they're moving into community and other types of media that's behind a paywall. And I was talking to this Substack person. I said, well, Substack's great, but there's OnlyFans, there's Patreon. She says, what, do you want to start an OnlyFans page and let that show up on your credit card account, and then your spouse will see it? And so it's a very good point. If OnlyFans is known for adult content, a creator like me or a athlete creator probably wouldn't want to create on that platform just for the connotation that is for adult content. So if you hear someone has an OnlyFans page, like, oh, okay, they must be showing nudes or whatever, whereas a Patreon or a Buy Me Coffee or a Substack certainly is more geared toward journalists. These other platforms are more suitable. So you have that reputation of being friendly to adult content creators, then you're going to get adult content creators. And if you're spending money on OnlyFans, you're probably doing it for adult content. OnlyFans, controversial company, but I've been following this one for quite a long time. I actually had an article on my other website, Retired Before Dad. I had some of this type of content on that website. I brought it over to Access IPOs probably about a year ago. I've been following this story for a long time, and it's interesting to see the kind of structure that is behind a company that's generating so much revenue. And the fact that it's owned by really one guy who's just making all this money, you'd think he'd want to just hold on to that golden goose and let it pay dividends. But I think from an ownership perspective like that is probably a lot of risk to just holding all of your assets in just one company like that. And there may be some legal issue. There was some allegations of inappropriate material on there regarding children and just in that industry. it's a risky industry. Maybe this guy's looking to divest and get out of it, or maybe he's going to look to sell a part of his stake, maybe a majority ownership, and bring in some other investors to spread the risk a little bit. But it's not a bad situation to be in if you have 100% ownership of an $8 billion company and putting it out there for sale for whoever is qualified to bid for such an opportunity. Speaking of membership communities and behind paid walls, go to patreon.com/accessipos to support the show and to get bonus content. I'm not an adult creator, but I do offer curated news and weekly deal alerts. When I see deals that are happening on the secondary marketplaces, I aggregate all that data and share once a week, and sometimes in real time. And I share that to the community in the Patreon, in the Access Club. That's how a lot of creators earn to invest back into the show. So my goal is to grow this show quite a bit. So anything that comes in from support goes back into the production of the show, and a better show with better production and a little bit of help will just make the show better over time. You can also support the show by simply liking us or following us wherever you consume your podcasts or your videos. So that'd be YouTube, Spotify, Apple, or anywhere else, iHeartRadio. There's a bunch of them, Amazon Music. So there's always a link in my Sunday newsletter to anywhere you can watch the show. You can also just go to the website. There's a podcast icon in the menu. Click on that and you can find the show there. So very easy to find the show. It's very easy to give it a 5-star review. And by doing that, you're helping the show grow. And we're seeing good growth in subscriptions and follows and newsletter subscriptions. So keep it up. I appreciate you sharing, telling your friends, and supporting the show any way you can. Know that I really appreciate anybody watching the show, especially it's only 13 episodes long, right? So it's kind of early in the podcast life. But all your support at this stage so far has been great. I just hope you continue watching the show. I'll produce better content as we move forward. And hopefully we get more IPOs so that there's lots more to talk about and lots of participation in the growth of these really disruptive companies coming in the pipeline. That's all for the show. Thanks for watching. Thanks for listening, and I'll see you next week. This video is not a recommendation to buy or sell any startups mentioned. Pre-IPO and IPO investing involves significant risk. Conduct due diligence by reading the SEC S-1 filings before participating in IPOs. Do not invest in IPOs with money you cannot afford to lose. Thanks for watching.